Most of us want the same thing, to eventually stop making this daily commute and replace our job's salary with passive income from the stock market. The most common mistake beginners make is yield chasing. They search for stocks with the highest possible dividend percentage and buy them without looking at anything else. This chart shows the trap. When a company's underlying business is failing and the stock price is dropping fast, the dividend yield looks massive. It's a lure for investors who don't see the business is in trouble. Eventually, the company goes bankrupt and the stock price hits zero. You lose the value of your initial investment, and that high dividend payment disappears completely. Sustained passive income comes from owning profitable businesses. You prioritize the strength of the company first. The dividend is a byproduct of its success. Even a strong business carries risk.
If you rely on a single stock for your retirement, and that specific company faces a lawsuit or a change in the market, your entire income stream is in jeopardy. Exchange-traded funds, or ETFs, solve this by pooling dozens of different companies into one basket. If one company in the fund struggles, the ETF simply replaces it with a better performer. To turn these funds into a salary replacement, you need a Dividend Reinvestment Plan, or DRIP. This chart tracks a consistent investment of $1,000 a month over 30 years. Instead of spending your cash dividends, a DRIP uses that money to automatically buy more shares of the fund. After 30 years, this reinvestment adds over $1.5 million to the total portfolio value, compared to standard growth alone. It also more than doubles your eventual monthly paycheck. To reach these numbers, you have to choose the right vehicle. You must match your investment timeline to one of 5 distinct ETF categories.
The first category is the baseline for most portfolios: core U.S. foundations, funds like SCHD and VIG, built on established American companies. You accept a lower starting yield, usually between 1.5 and 3.4%, for 2 specific benefits: high stability and a history of growing dividends 7 to 10% every year. If you want to prioritize reliability even further, you can look at the Dividend Aristocrats, found in funds like Noble. To enter this category, a company must have increased its dividend payout every single year for at least 25 consecutive years. These companies provide a safety net during market crashes, but they are mature businesses. You shouldn't expect the stock price to grow as quickly as younger, more aggressive firms. These foundational funds are reliable, but they require a 10 to 15-year horizon for the compounding dividend growth to reach salary replacement levels. For investors seeking more aggressive expansion, mid-cap growers like REGL and Pay offer a different path. Mid-caps are established, operational companies valued between $2 and $10 billion. They have moved past the risky startup phase, but haven't yet reached the size of massive tech giants. Their advantage is growth potential. Because they are smaller, they have the room to capture more market share and hike their dividend payouts faster. The trade-off is higher volatility. These businesses are highly sensitive to market swings and carry a greater risk of failure than the blue chips. You can also diversify geographically through international exposure ETFs, like VYMI or SCHY, which look at dividend payers outside the US. International funds often offer higher dividend yields today than their American equivalents. However, going international introduces geopolitical risks and currency fluctuations. You also miss the explosive growth that has historically come from the US tech sector. Mid-caps and international funds raise your potential yield ceiling, but they require you to endure much sharper short-term drops in your portfolio value. The final, and perhaps most popular category right now, is covered call ETFs, such as JEPI and JEPQ. These funds generate immediate yields of 8 to 10%. They achieve this by renting out their stock holdings to options traders for a premium fee, which is paid to you. This creates a hard ceiling on your portfolio. In a strong market, your investments cannot rise past that cap. Over time, traditional ETFs compound, while covered call ETFs show virtually no stock price growth. You trade future wealth for larger paychecks today. For anyone using a long-term DRIP strategy, these funds are a trap. They offer immediate cash but sacrifice the compounding needed to build a permanent salary replacement. Determining which fund is best is impossible without knowing your age and your immediate need for cash.
If you are the long-term builder in your 20s, 30s, or 40s, your horizon is over 15 years. Your path leads toward core US, aristocrats, and mid-caps. You prioritize historical dividend growth over current yield, letting compounding build your wealth. If you are the income maximizer, near retirement and needing to replace your paycheck today, your strategy changes. In this stage, you can sacrifice future growth. You might use covered calls and international funds to capture the highest possible cash flow right now. Choosing the wrong category for your timeline, like a young investor buying covered calls for the high yield, will limit your final portfolio value. Even with the right fund, you will face the ultimate psychological test, a major stock market crash. Most investors panic when they see their portfolio lose value. They sell their funds at a loss, which permanently stops their dividend income and destroys their progress. You must follow the always be buying strategy. When the market is down, you treat those red days as a discount on future income. Buying during a crash lowers your average cost, which increases the total number of shares you own. This results in higher dividend payments when the market stabilizes. Replacing your salary with dividends is a long-term structural commitment. You match the ETF to your timeline, you reinvest your profits, and you let the math work for decades.